Good morning, everyone. My name is Michael Naidrich, and I am the co-CEO of Amerivet Securities. As always, I am joined by my partner, CFA, all things rates, Fed, liquidity, Gregory Faranello. Hey, Greg, good morning. How are you, sir?
Good morning, Michael.
Happy St. Patrick's
Happy
Day.
St. Patrick's Day. Yeah.
Yes, sir, to you and all of our clients and friends. Look, let's jump right into it. I'm going to throw it right to you just to kind of give us a little bit of an overview. There is so much going on heading into this meeting. So why don't you take an early crack at it, and then we'll have some Q&A together.
Yeah, that sounds good. I mean, there's definitely a ton going on. I would say with the Fed this week, and we also have meetings from the Bank of Japan, Bank of England too. But obviously, the Fed front and center. We know there's not going to be any formal change in terms of interest rates. We'll look at their statement. The economy has certainly slowed. I think Powell will acknowledge that at some level. I don't think he'll harp on that. And at the same time, if you look at the inflationary numbers, if you annualize these numbers, I mean, we're still well above the Fed's target. The Fed has a policy review in place right now, which will come out in the summer. And the chairman is saying 2% is not on the table. So when you look at that, it's meaningful. And then summary of economic projections, we get these quarterly. We think they'll downgrade GDP, which makes sense because it does appear the economy is slowing. And in conjunction with that, maybe up their unemployment target in terms of where they see that going a little bit looser over time. And then with rate policy, look, it's going to be 2 or 3 rate cuts for this year. We favored a little bit more toward 2. It could be 3, and then a slow trajectory, I think, over the next couple of years down to where they perceive neutral to be. And I think that neutral rate is coming up. So call it 3.25, but certainly no rush to get there.
Yeah, so I think that's the theme, right? I think you've been pretty steadfast, thinking 2 to 3 cuts. I'm leaning towards 2, but right now, I think if I'm getting you right, maybe just a little too early for the Fed to move here.
Yeah, look, I mean, it's who knows, right? I mean, if I'm sitting in Chair Powell's seat right now, like they don't know, right? No one really knows per se, right? We've got all these variables in place. You've got tariff policy, global trade. You've got the economy that's sort of digesting all this stuff. So I don't think the Fed knows. And look, it's okay for the Fed to come out and say, look, we just don't know right now. So we like where we're at, and we're just going to sit here for a little bit of time. There's nothing wrong with that.
I agree, and I know people are looking for some sort of relief in the cuts, but I agree with you. I don't think we're going to see it. Let's talk about the markets in general. Obviously, very unsettled right now. People are Trump has this markets on its toes to say the least. I think if you look at valuations, it's not crazy to say a repricing here makes some sense. And I know we heard from the Secretary of Treasury saying, hey, this is healthy. I was just wondering what your thoughts were there.
Yeah, I don't know. I listened to his comments over the weekend. I'm not too sure. I'm not too sure it's healthy, but it's real. So, in 2021 into 2, we had all this federal spending and we had this inflation. The Fed had to come in. They had to tighten. They had to rein things down a little bit. I kind of view what's going on right now is Trump is almost tightening, right? He's tightening policy. It's not the Fed, so it's not as transparent because we can say, okay, we're going 25, 50, or 75. It's a different animal, but they are tightening to a certain extent. The market does not like it. And look, we're going to have to work through this period of time. I will say this much. It's hard to predict where we're going necessarily, but we've provided context on social media to our clients. It's been far worse, right? When you look at the VIX, when you look at the CDX, you look at, investment grade is catching up a little bit here. When you look at these pockets of time over the last 10 to 15 years, we've been far worse than where we are now. I think what's most important right now to me, and you and I haven't caught up a lot lately because you're you're traveling all around the country. I mean, what are clients saying here?
Yeah, we were going to get there, and this is a good pivot point to that. I think what clients are saying overall is there's just so much uncertainty out there, and the tariffs are creating a lot of uncertainty. And I think you saw at the end of last week there was probably more stand downs on issuers that wanted to go last week on the go no go calls, which are fully back into the market, which we know for years that it seemed like they wasn't even a no go cold call. Look, people are still going to issue, especially the banks, right? But I think people are trying to figure out when they can get a pocket to issue. And I think in talking to these clients, and we were on the road through the whole West Coast last week. We were in Arizona, LA, and San Fran. People are going to issue. I think rates are still historically okay to issue debt. And believe it or not, I think there's still some folks out there waiting for the rating agencies to kind of change their viewpoint on some of these companies that they've been waiting for years in many cases to issue. So, I think there's a lot of consternation, to say the least. Treasury teams like sort of straightforwardness, and they don't have that right now. And I think it's to your point when we were talking the other day. There's sort of this hangover where Trump, sort of like Xi in China, is orchestrating this, which you were alluding to a little bit earlier. And I think if we were being fully honest, there's a little frustration still from Trump for not having consecutive terms in putting some of this together. So, I think a little bit of that is, frustration on Trump that he didn't get to play long ball, right? Right, because of the non-consecutive terms. I'd love to get your thoughts on that.
Yeah, I mean, I think you hit the nail on the head. When you listen to the president speak, and I'm not being critical, at times he will continue to revert back to the fact that if I was president back then, these wars would never have started. The reality on the ground is they have started, and it's in focus right now. I do think we need to give him a little time. We need to give this administration a little time. I think part of the challenge, Mike, as you and I know, these markets are completely impatient, right? So we roll into 2025 with all this inflation. The inflation really hasn't gone away. The overall price structure is still high, right? So consumers they're still kind of pissed off here, right? It's like, I go do this, I go do that, I got to pay my insurance. The rate of change has come down for the Fed. And I think Jay Powell knows this too. The rate of change has come down, but people are still frustrated with prices. So now it's like, well, you won the election, you got to fix prices. I do think over time, I do believe this. And Scott Bessent, the Treasury Secretary, said this over the weekend. It's painful. It's a painful pocket of time. He's like, look, give us time to get good policy in place. Over time, good policy will lead to lower prices, hopefully a good economy. But the markets they're not buying it right now. So,
Yeah, and
right?
I think, Greg, and again, me, I'm politically independent, but I think Trump does shoulder some of the responsibility for this in that, he said, I will fix this, I will fix that, and he didn't give himself a normal cadence of time to fix some of the stuff. And I think, it's interesting to watch the markets because you're going to see these vicious swings, right? Depending on what the highlights are, the economic numbers that come. And, I do believe that, even if it may not be by choice, at least now the mantra coming out of the White House is, we're okay if markets go down more. If as long as our policies set moving forward. And in all fairness, I think there's many examples of markets having these very sharp corrections where they end up higher at some point, as long as the policy, is successful. So I was wondering your thoughts on that.
Yeah, look, I mean, I think these things take time. I mean, we started writing to our clients, Mike, as you know, late last year, like this is not going to be turn one switch off and another switch on. And then you look to Europe right now. I mean, the European and Chinese markets are doing great. China is supplying a ton of liquidity. It's not really a reflection of how their economy is doing. Even Europe, they're weak. I mean, the central bank has been lowering rates. Canada, the same thing. I do think, look, things are going to be okay over time. I mean, certainly US, Canada. I've got an affection for Canada. There's no question about it. I'm not shy about putting that out there. I mean, I think they are one of our biggest allies, if not biggest. And I think we'll get some good things done there over time. Look, feelings are being hurt here. There's no question about it. And we're just going to have to work through it. I think ultimately, the US markets, when I look at the last 2 to 3 years, we've done absolutely fantastic. AI craze, central bank, the Fed lowering rates, the economy doing great, a lot of spending from the fiscal side. Now there's a rethink. We're suffering because of that. We could suffer, I think, a little bit more, but I think ultimately we're going to be okay. And I think, look, ultimately everyone is going to be okay. I mean, we want peace. We want prosperity. I think that's the end game. In the interim here, we're going to have to fight through it. And it's a little painful.
Yeah, let's talk about something that I think might be the most important thing we talk about today. There's always so much focus on the equity markets, right? We see it, it's all day long, CNBC, Bloomberg, etc. Well, let's talk about the credit markets, and there's been some widening here. Nowhere like we've seen in the last decade and a half, right? But there is some widening, and look, the bond market is very, very important. I mean, my opinion, multiple times more important in some ways than the equity market, right? Can you opine a little bit on what we're seeing with spreads in the credit market?
So we follow the credit markets almost exclusively. I do, from a macro perspective, I do watch the equity markets in terms of what they're doing. Last year, we spoke about this yen carry trade unwind
Yeah.
in the middle of the year. I think it was July. And you and I spoke, and I said, look, it's not a credit event. This is an equity event. It's positions. We're unwinding. This is somewhat akin to that. My view short term with the credit markets was we had some catch up to do, right? So we're watching, the equity markets unwind. We're watching certain sectors unwind. And the credit market was doing pretty good. We're catching up here a little bit. So if you look at IG, if you look at high yield in particular, you look at investment grade, OAS spreads. If you look at the CDX, we're certainly catching up here. What I'm trying to do is look at this pocket of time in the context of the biggest market moves that we've seen over the last 15 to 20 years, the global financial crisis included. You look at 2015, 2016, we had a hiccup with China. Chair Yellen at that time was trying to raise rates. Chair Powell in 2018, he tried to raise rates. He got to 2.5%. The credit market started to unfold. And then, we moved into 2019, 20. The economy was good in 19. Into 20, we got clocked with this pandemic. I mean, that was like, the beast of all beasts. And, the central banks came in. Then we had 2023, we had the regional bank hiccup. 2024, this unwind. I think credit, ultimately, if the economy is going to be okay, which I think it will be, I think credit will be fine. I also think when you look at private and public credit right now, I think there are a lot of private hands that are involved in the credit market, which is it's a game changer. It hasn't happened yesterday. It's happened over the last 10 to 15 years. So if you're somewhat constructive that we get through this period of time, then I think credit will be okay. But having said that, when you look at tariffs, you look at a global trade war, there are companies within these private equity, firms that, we have to keep a close eye on as well. So time matters here.
Yeah.
We can't let this drag on we can let it drag on for another couple of months, but we're going to need some clarity at some point here, or, things could turn worse for sure.
Yeah, so I agree, and I guess as we probably have to wrap it up here a little bit, I'll ask one more question. Leaving probably another five or six on the table, but there's so much going on. As we know, weeks go fast, months go fast, God, even years go fast, and here we are. It's St. Patrick's Day and April 1st, and tariffs are right around the corner again. Give us a little something to think. Are we going to see some deal making here in the next week and a half? that will put some relief on these tariffs, or do you think, these things are going to go through and where's that leave us, come, the second quarter of the year?
So day one, inauguration day, the president issued an executive order about reciprocity and getting feedback from the Department of Treasury, the Department of Commerce, and Trade. That was a day one order. I'm not too sure too many people were paying attention. The deadline for that was the beginning of April, April Fools. This is not going to be an April Fools, but I do think the concept of reciprocity, to me, I think part of the tariff roll-off, what they're rolling out here, it's confusing to people. Reciprocity is pretty straightforward. If you tax us 10% on cars and we're at 2%, we're going to be at 10% unless you want to come down. So the goal ultimately, and I'm not too sure too many people are going to buy into this right now because they're going to need to see the proof. The goal ultimately is to get all tariffs down, right? So let's not be at 10%. We may not be at 2%, but maybe we're at 5%. So that deadline is coming. I do think we're going to get some more clarity here. And I also think, to your point, Mike, I think there's a lot of conversations that are going on behind the scenes. Mexico themselves, they came out and said, look, we're waiting for this April date. So it's an important date. That first week, reciprocity, we're going to get clarification, I think, from the administration. In conjunction with that, we're going to get the employment number too. So I think there are better days ahead. It's going to be choppy going forward. But I think, look, one way or another, whether you like it, you don't like it, everyone just wants a little bit more clarity in terms of what they're dealing with.
Yeah, I think that's the theme. And even Jamie Dimon came out and said that, right? His voice holds a lot of weight, obviously, out in the business world and, globally across the board. Here's what I'll say to our clients. This is about 15 minutes today, which is usually about 4 or 5 minutes longer than we go. I don't think we even touched on 75% of what we should get to, but we do have limitations here. So I would encourage all of our clients to reach out to your representative, see if you can get Greg on the phone or Zoom so we can get, continued viewpoints that I think are second to none. So Greg, I look forward to Wednesday. I think we'll see a lot of issuances tomorrow as long as the market holds up leading into the Fed on Wednesday. And as always, look forward to you deciphering the minutes because I think, that's where the rubber meets the road anyway. So thank you for your time, bud. Always enjoy this. This is like, I don't know, 6 years running or something like that. So we'll continue to do this and just thank you, thank you to our clients for supporting our platform in a meaningful way. Have a good St. Patrick's Day.
Thank you, Michael. You too.